Welcome to Talk Tickers. Today, we're digging into Scholastic's first quarter fiscal 2026 earnings call from September 18th. Now, management did their best to paint a pretty constructive picture, but let's just say the market's reaction told a very, very different story. And that story really starts with this number right here. Before we even get into the weeds, you just have to look at the market's immediate verdict, a 10% drop in after-hours trading. That is a huge move, and it tells you right away that investors were absolutely not buying what management was selling. So here's how we're going to break it all down. First, we'll tackle the headline miss that really triggered this whole sell-off. Then, we'll dive into this deep divide between the company's different business segments. We'll unpack management's strategy to try and turn the ship around, analyze why the market is so skeptical, and then we'll finish up with our rating on the stock. Okay, let's get right into it. The headline numbers. This is what set the immediate and very negative tone for the quarter. And here it is, in black and white. It's not pretty. Scholastic missed on both the top and the bottom lines. Revenue came in at about $225.5 million, falling way short of the nearly $240 million the street expected. And on top of that, it's a 5% drop from last year. The loss per share was also wider than anyone was hoping for. I mean, there's no way to spin this. It was just a clean miss across the board. But here's where the story gets a little more complicated, and frankly, a lot more interesting. If you just look at those headline numbers, you're missing what's really going on. Because this isn't just one struggling company. It's really a tale of two completely different businesses pulling in opposite directions. And this chart just lays it bare. Take a look. The core children's publishing business, the famous book fairs we all grew up with, that part actually grew a respectable 4%. Great. But that good news was completely wiped out by a catastrophic 28% collapse in their education solutions segment. I mean, that is a massive, massive hole in the business. So what on earth happened? Well, CEO Peter Warwick was pretty direct about it. He pointed the finger squarely at a volatile funding environment for schools. Essentially, federal grants are getting delayed or even canceled, so school districts are slamming the brakes on spending, and Scholastic's education business was standing right in the path of that truck. So, with that really ugly backdrop, how did management respond on the call? Well, they tried to strike this cautious, constructive tone. They admitted there was short-term pain, but they insisted their long-term strategic plan is not only on track, but it's the answer to all these problems. So what is this grand strategy? It all boils down to two key ideas: portfolio tightening and going asset light. Now, in plain English, that just means they're trying to become a leaner, more efficient company. They want to sell off some valuable real estate to get cash, slash their overhead costs, and then really focus on monetizing their incredible library of intellectual property. We're talking about global blockbusters like Harry Potter, The Hunger Games, and Dog Man. And they've got a pretty clear three-part plan to get it done. First, sell off the real estate they own in New York and Missouri to unlock that capital. Second, keep a tight grip on costs. And to their credit, they already cut overhead by over $6.5 million this quarter. And third, spin that IP flywheel faster, with new releases, streaming shows, and licensing deals. To prove they weren't just blowing smoke, management did point to a handful of bright spots. They made a big deal about fall book fair bookings tracking ahead of last year. They have a huge new Dog Man book dropping in November, which is always a monster hit. And here is the real kicker. Despite that awful Q1 miss, they stood by their full-year guidance, which actually projects a return to growth. Okay, so if management is so confident, why the massive sell-off? This brings us to the market's verdict. And this is where we see the huge disconnect between the story management is telling and how investors are actually hearing it. This slide just lays out the conflict perfectly. On one side, you have management trying to focus everyone on the future, the affirmed guidance, the strong book fairs, the IP pipeline. But on the other side, you have the market, and it is laser-focused on the ugly reality of right now. The Q1 miss, that 28% collapse in education, and one other major red flag: worsening cash burn. And that cash burn is not a small number. The company burned through over $100 million in free cash flow in just this one quarter. For a company that's talking all about strategic pivots and long-term health, burning that kind of cash is a major, major warning sign for investors, and it really helps explain that 10% stock drop. So this all brings us to our final analysis. After weighing all the evidence, it's time for the next call, where we give you our rating on the stock and what we're watching for. You know, the entire investment case right now just boils down to this one simple question. After a truly disastrous first quarter, is management's confidence in their full year guidance actually credible, or are they just hoping for a miracle? So the bull case, the optimistic view, rests on a huge second quarter. They believe strong book fairs and the new Dogman book will make up for the Q1 shortfall, plus they'll get cash from real estate sales. But the bear case is powerful. It says the problems in the education segment look severe and maybe even permanent, not temporary. And that huge cash burn just puts immense pressure on the company to execute its strategy flawlessly. There's just no room for error. So our call is underperform. Look, while we absolutely respect the publishing business, the hole created by that 28% decline in education is simply too deep to ignore right now. To hit its full-year guidance, Scholastic would need a truly heroic performance in the coming quarters. And given the headwinds, we see that as a pretty low-probability bet. The key question now is whether this weakness is just a temporary storm or if this is the new normal. And to close, just a quick reminder. This analysis is for informational purposes only. It is not and should not be considered financial advice.